Welcome back to the Deep Dive. We're the show that tries to cut through the noise, get to the essential insights you need to really make sense of things.
That's the goal.
And today we're diving into, well, a bit of a financial mystery, something that might make you scratch your head, even if you follow company news pretty closely.
Oh, yeah.
Yeah, you've probably seen it, or at least heard the chatter. A company says, hey, we're issuing new shares, raising capital, right? Maybe for a big expansion.
Sounds positive, usually. Growth on the horizon.
That's what your gut says. Great, growth opportunity.
But then you watch the stock over the next few years. It often underperforms, does worse than the market.
Okay.
And then there's the flip side. A company decides to give money back. Dividends, share buybacks.
Returning cash to shareholders.
Exactly.
Huh?
And almost counterintuitively, its stock tends to outperform in the long run.
So raising money is bad for the stock long term, giving it back is good. That does seem backwards. It feels like the market's playing this really complicated game, you know, where common sense, well, it doesn't always seem to apply.
It's a pattern that really challenges our everyday intuition, doesn't it? I mean, raising capital usually suggests a firm sees good prospects, right? Confidence.
Yeah, you'd think.
And returning cash. Well, maybe it suggests a lack of those opportunities. Yet for decades now, the data, it just consistently shows these long-term splits, creates what finance folks call external financing anomalies.
External financing anomalies.
Oh,
Okay. And they've been a real persistent thorn in the side of traditional financial theory.
A thorn in the side. I like that. And that's really our big question today. What is the fundamental force driving these patterns, these seemingly paradoxical results?
Right.
Is it just investors acting irrationally, consistently misreading the signs? Or is there maybe a deeper, more, elegant economic explanation happening?
That's the core debate. So our mission today is a deep dive into this really fascinating and I think quite impactful study. It's by Erica Lee, Dmitry Livden, and Lu Zhang, simply titled Anomalies.
Aptly named.
Very. And this paper, it presents a really refreshing neoclassical view on these market behaviors. It moves beyond just, blaming psychology. And it uses a surprisingly robust Q theory model to try and unravel where these patterns actually come from.
Yeah, this work really stands out.
Yeah.
Because it doesn't just explain one little thing, one anomaly. It offers this unified single framework.
A single framework for multiple things.
Exactly, to account for several different, often disconnected empirical observations in finance, things people used to explain separately.
Okay.
It's really a testament to how fundamental economic theory, when you apply it rigorously, it can provide some profound clarity on these complex market things, often with a kind of elegant simplicity, even though the underlying mechanics are complex.
I couldn't agree more. So by the end of this deep dive, you, our listener, should walk away with a much clearer picture of why these patterns pop up.
Hopefully, yeah.
And how they challenge that sort of long-held conventional wisdom about market efficiency. And crucially, how a seemingly straightforward economic model can actually explain such intricate market behaviors. And, often with remarkable precision.
That's the goal. To unpack the mechanics.
We're going to dissect this, shine a light on the really surprising connections, and think about what it all means for how you perceive, company value and market dynamics.
Sounds good. Let's get into it.
Okay, so let's start by just laying out the puzzle, the actual patterns we see, the empirical evidence on external finance.
Right, setting the stage.
For a long time now, empirical finance, researchers have been meticulously documenting some really peculiar, persistent trends. The first one, maybe the most famous, is the equity issuance puzzle.
Ah, yes, the classic.
Picture this. A company, maybe a growing tech firm, needs a big chunk of capital for R&D, global expansion, maybe an acquisition.
Common scenario.
So it issues new shares to the public, a seasoned equity offering, an SEO. Now, in a, let's say, perfectly rational, efficient market, you might think, okay, positive signal, right?
Means they see good investment opportunities.
Yeah.
Should be good news.
That's the logic.
Yeah.
But what the data consistently shows is that, on average, firms that issue new equity, they tend to earn lower average stock returns afterwards, like in the following 3 to 5 years, often significantly underperforming their peers.
And this isn't just like a blip, right? It's not a temporary thing.
No, not at all.
This long-term underperformance is a really robust finding. People like Lawford and Ritter brought it to everyone's attention back in the mid-90s.
Right.
And it's not short-term. We're talking a persistent drag on returns for years. And that duration That's what makes it so tough to square with the traditional efficient market hypothesis.
Explain that a bit more. Why the duration?
Well, the EMH basically says any new public info, like an SEO announcement, should get baked into the stock price immediately,
Right.
fully reflected.
Instantly.
So there shouldn't be any predictable future returns left over. The very fact that there's this multi-year drift, it challenges that fundamental idea.
Gotcha. So the market isn't instantly pricing it in, according to this evidence.
Or at least that's what the pattern suggests.
Okay, so that's puzzle number one. Then we have its intriguing inverse, the cash distribution outperformance.
The other side of the coin.
This is where firms actively give capital back to shareholders, regular dividends or maybe share repurchases, buybacks. These firms tend to see their stock earn higher average returns in the future, again, over a similar 3 to 5 year period.
So issuing stock gets punished, giving cash back gets rewarded long term.
Exactly. And again, in a world where new capital often seems like fuel for growth,
Right.
and returning cash might imply, fewer great places to invest it, this long-term pattern feels fundamentally contradictory. It just doesn't fit that simple story.
These two things together, the post-issuance underperformance and the post-distribution outperformance, they're absolutely critical. They really frame the debate.
How so?
Well, they present this documented substantial challenge to our cornerstone asset pricing models, like the capital asset pricing model, CAPM, and its variations.
Because those models assume efficiency.
Basically, yes. Traditional models build on the idea that expected returns are mainly driven by systematic risk. Beta, right? If markets are efficient and all info is priced instantly, then these predictable long-term return patterns, patterns that seem unrelated to traditional risk measures, they just shouldn't exist.
So their existence implies?
It implies either a massive, persistent mispricing by investors or maybe a fundamental misunderstanding on our part about what truly drives risk and return.
Okay. That sets up the problem nicely. So for a long time, what was the go-to explanation for this?
For quite a while, the prevailing explanation really leaned into behavioral finance.
The psychology angle.
Exactly. It's widely known as behavioral market timing.
Market timing. Okay, what's the story there?
The underlying idea is pretty appealing, actually. It's almost a story of, shrewd managers outsmarting the market.
Okay.
The idea is that corporate managers, they're astute observers, right? They exploit market inefficiencies. They issue equity, sell new shares when they think their company's stock is overvalued.
Sell high. Makes sense from their perspective.
Captures that inflated price for existing shareholders. Conversely, when they believe their stock is undervalued, they might use internal cash or maybe debt to fund things. They avoid issuing equity cheaply.
Okay, so managers are playing the market.
That perspective was really powerfully put forward by Lofgren and Ritter back in their 95 paper you mentioned.
Right.
It suggests managers are acting rationally in the interest of their current shareholders by exploiting temporary mispricings. But there's another key part to this behavioral story.
Which is?
Investor underreaction.
So the market doesn't get it right away.
That's the theory. It posits that ordinary investors, they don't immediately, or maybe not fully, grasp the information signaled by these financing decisions.
So they don't see an equity issue and think, uh-oh, maybe it's overvalued.
Not instantly, or not strongly enough, according to this view. Same for buybacks, signaling undervaluation. This delayed or incomplete reaction from the market. That's what supposedly leads to those long-term predictable price drifts we see over years.
Okay, so if managers are timing things cleverly, and investors are slow on the uptake, that lag naturally creates those multi-year underperformance or outperformance patterns.
That's the logic.
It's an explanation that seems to fit.
Right.
At least on the surface.
Yeah.
Especially if you think markets aren't perfectly efficient.
It does have intuitive appeal.
And that really is why this whole area is such a big deal in finance. These anomalies, they fundamentally challenge that core notion of efficient markets. They raise these serious, kind of uncomfortable questions about how we value assets.
Absolutely.
If these patterns are real and they stick around, then those traditional models like CAPM, the ones assuming rationality and instant information processing, they really struggle. They just can't fully explain it.
Right. It suggests either a systematic flaw in how we think about risk and reward, or maybe a persistent, exploitable opportunity for people who can spot these patterns.
Precisely. The fact that these long-term drifts continue implies there's some predictable component in stock returns that isn't fully captured by just looking at beta or traditional risks.
And that stands in direct contradiction to, strong forms of the efficient market hypothesis. It forces us to think about two main possibilities.
Which are?
Either our current asset pricing models are just incomplete, they're missing some crucial risk factors that could explain these patterns,
Okay.
or indeed, market participants are systematically mispricing these corporate financing events over long periods, which opens the door wide for those behavioral explanations.
Okay, so we've really laid out the puzzle now, the facts we see, and that long-standing behavioral explanation. Now, let's pivot. Let's explore the really fresh perspective this deep dive offers.
The neoclassical alternative.
Exactly. Instead of just relying on investor irrationality or managers timing the market, Lees, Livdon, and Zhang introduced this compelling neoclassical alternative. And it's rooted firmly in Q theory.
Q theory. Okay, maybe a quick refresher for folks.
Good idea. So Q theory, at its core, it provides this powerful link between a firm's investment decisions and its market value.
Right.
The Q in Tobin's Q, it's essentially a ratio, market value of the firm's installed capital divided by its replacement cost.
So what the market thinks your existing assets are worth compared to what it would cost to rebuild them from scratch today.
Perfect. And when Tobin's Q is high, meaning the market values your assets at more than replacement cost, it signals that the market sees really valuable opportunities for you to invest more. It gives firms a strong incentive to invest.
And conversely, if Q is low, market value is less than replacement cost, it suggests maybe investing more won't create enough value.
Yeah.
So it discourages investment.
Exactly. It's a fundamental economic concept. It links market signals to real-world decisions about where firms put their money, a really powerful lens for looking at investment.
Definitely.
Now, what's truly fascinating here, the central argument of this paper, it isn't really focused on market timing in that behavioral sense we just discussed.
Okay, so what is the focus?
Their core insight is that optimal investment decisions made by firms. Those are the primary underlying drivers behind these external financing anomalies.
So it's about the firm's rational choices.
Precisely. It's not just about clever managers outsmarting the market. It's about fundamental, rational economic choices firms make to maximize their long-run value. Given their production technology, their costs of adjusting capital, how easy or hard it is to get financing. This frames the anomalies not as like market failures or investor mistakes, but as natural outcomes of rational corporate behavior in a dynamic economy.
That is a significant reorientation, instead of looking for glitches in investor psychology.
Right.
The paper tries to explain these market patterns through microeconomic optimization at the firm level, and how those decisions kind of aggregate up to affect asset prices.
Yeah, it's a really compelling example of how a well-specified neoclassical model, it can generate these complex empirical patterns that before people often just attributed to behavioral stuff.
So how does the model actually work? What are the key ingredients?
Okay, let's take a quick look under the hood. We'll keep it relatable, focus on the intuition. First up, technology and production.
The basics.
Right. Firms need capital to make stuff. Their productivity isn't constant. It gets hit by shocks. Aggregate shocks, economy-wide ups and downs affecting everyone.
Like recessions or booms.
Exactly. And firm-specific shocks, unique things hitting just one company. A breakthrough innovation, maybe, or a supply chain mess.
Okay.
And a really crucial feature here is decreasing returns to scale.
That sounds important. What does it mean?
It means as a firm invests more, it gets bigger. Its output increases, yes, but by a smaller proportion than the increase in capital.
Got it. So doubling your capital doesn't necessarily double your output. Maybe it only increases it by, say, 80%.
Something like that. The efficiency gains diminish as you scale up.
And this assumption, decreasing returns to scale. It's absolutely pivotal for the model's explanation, right?
It's hugely pivotal.
Think about it. A small, specialized software company, add a few key developers, a powerful server, boom, maybe a huge leap in productivity.
Right.
But if they try to scale indefinitely, add thousands more developers, tons of servers, without proportional increases in management, coordination, market demand. Eventually, each extra unit of capital, each extra person, becomes less productive on the margin.
Why would that happen?
Could be many reasons. Limited managerial attention, right? You can only oversee so much effectively. Rising coordination costs harder to keep everyone on the same page. or just diminishing returns to some fixed factor, like maybe market size or specialized expertise. Economists like Lucas explored this idea way back.
So it sets a kind of natural economic limit on efficient expansion.
Exactly. A point where just throwing more money at it yields less and less extra output.
Okay, that makes sense. Decreasing returns are built in. What's next in the model?
Next, the model brings in tastes and a discount factor.
Sounds a bit abstract.
It is, but it's basically how investors value future cash flows. The model uses a stochastic discount factor.
Stochastic meaning, random, changing.
Changing over time, yeah. It's just a fancy way of saying that how much investors value a dollar tomorrow isn't constant. It depends on the overall economic climate.
Okay.
This factor ultimately influences things like real interest rates and the Sharpe ratio, that key measure of risk-adjusted return. Basically, it determines how much compensation investors demand for taking on risk and for waiting to get paid back.
And why is it stochastic? Why does it change?
Well, it's critical for linking the firm's operational decisions to its market value and expected returns. By letting this discount factor vary, typically, it's higher in bad times when investors are more risk-averse.
Right. They demand more compensation when things look scary.
Exactly. The model captures how the market's required rate of return changes with the business cycle. This dynamic element lets the model generate time-varying expected returns, which we definitely see in real-world markets.
Okay, so it reflects a dynamic, risk-averse market.
Got it.
Yeah.
And this brings us to the core, right? Corporate policies, investment, and financing.
This is where the action happens.
Within this framework, firms are always trying to pick the optimal level of investment, the level that maximizes their equity value, their share price.
Makes sense.
But they do this under constraints. Capital wears out depreciation. And crucially, they face quadratic adjustment costs.
Adjustment costs. What are those, simply?
Think of it like this. It's just more expensive, less efficient to change your capital stock really quickly compared to doing it gradually.
Okay.
Need to build a new factory overnight? It's going to cost way more per square foot than if you planned it over a few years. The quadratic part just means these costs accelerate. The faster you try to adjust, the disproportionately higher the cost becomes.
Okay.
And these adjustment costs, they're a standard feature in Q-theory models, right?
Very standard.
They help explain why a firm's market value, Tobin's Q, can sometimes be way above 1, even if the physical assets cost less to replace. The market recognizes these internal nonlinear costs of changing scale quickly.
Right.
And it also naturally makes firms smooth their investment over time. They want to avoid those super high marginal costs of drastic sudden changes.
Okay, so adjustment costs slow things down. And this leads us straight to the critical financing choices. How do firms pay for this investment?
Good question. The model makes a key assumption here. External equity issuing new shares is treated as a last resort
Last resort, why?
because it's explicitly modeled as being costly to raise.
Ah, okay. Real world costs.
Exactly. Fixed costs, legal fees, underwriting, admin stuff,
Okay.
and proportional costs, a percentage of the money raised. This reflects tons of real-world evidence showing that tapping the equity market isn't free.
So firms would rather use internal cash first.
Absolutely. This assumption is fundamental. Firms rationally exhaust internal funds, maybe even take on debt
Yeah.
before they resort to costly external equity. It's just economically sensible.
Okay. What about giving cash back? Dividends, buybacks?
Interestingly, for simplicity, and really to isolate the effect of costly external financing, the model assumes that distributing cash back is costless.
Costless. Is that realistic?
It's definitely simplification. We know dividend changes can be costly signals. Buybacks have admin costs. But it serves a purpose here.
Which is?
It highlights the core preference. Firms use internal funds for optimal investments first. If there's cash left over after funding those, they return it because there are no barriers in the model to doing so. It sharpens the contrast with costly equity issuance.
Got it. So costly equity, costless payouts, and finally, this whole setup determines endogenous risk and expected returns.
Endogenous meaning, generated from within.
Exactly. This is where the model really shines. Things like beta, systematic risk, and the expected returns for different firms. They aren't just plugged in from outside, they emerge organically from the firm's own investment decisions, its productivity shocks, the cost of capital, the whole economic environment set up within the model.
That is a powerful distinction. A lot of traditional models kind of take risk measures as given or estimate them empirically.
Right.
Here, the model explicitly shows how a firm's investment choices, driven by its fundamentals and the economic cycle, actually shape its risk profile over time. and therefore shaped its expected returns. It's all connected internally.
It's a unified explanation. It avoids relying on sort of external or ad hoc assumptions about where risk comes from.
And that's precisely why this approach is so potent. It aims to simultaneously reproduce this whole range of stylized facts, those empirical regularities we talked about.
The anomalies.
Right, the ones previously explained mainly by behavioral market timing.
Yeah.
But it does it with a single, unified, rigorously neoclassical explanation.
It's like finding one key that unlocks a whole bunch of different doors instead of needing a separate behavioral key for each one.
That's a good analogy. It offers a more parsimonious, economically grounded story.
All right, now for the crucial link, the real pivot point of this deep dive. And this might just reshape how you think about company performance.
Okay, ready?
The model predicts a fundamental and really powerful relationship, a negative relationship between a firm's investment and its expected future stock returns.
Or hang on, negative.
Negative. Let that sink in. Companies that invest more today, they tend to have lower expected stock returns in the future.
And vice versa. Less investment means higher expected returns.
Exactly. Firms investing less today tend to see higher expected returns down the line.
That really does fly in the face of the usual story, doesn't it?
All right.
High investment equals growth, equals good stock performance.
Completely. So how does the model explain this apparent paradox? This is where it gets really interesting.
Okay, yeah. This negative investment return link. It's the linchpin of their whole argument, isn't it?
Right. Absolutely central.
It's saying there's a deep structural economic reason why high investment leads to lower future returns. And it's not about investors being dumb or managers just timing things.
Yeah.
It stems from the basic economics and value maximization of the firm itself. And the paper points to two distinct but connected channels driving this.
Okay, let's break those down. Channel number one.
Channel one is the cash flow channel. And it connects directly back to that decreasing returns to scale idea we discussed.
Okay. The idea that efficiency drops as you get bigger.
Right. So if a firm has decreasing returns to scale, what happens when it invests heavily? It pours more and more capital in. The marginal product of capital, the extra output you get from one more unit of capital, starts to decline.
Give me that bakery example again.
Okay, the artisanal sourdough place. Investing in a second oven, big boost. A third helps, but maybe less per oven. 100 ovens in the same small shop with the same few bakers.
Probably chaos. And not much more bread per oven.
Exactly.
Yeah.
Each new oven adds less and less to additional profitable output.
Yeah.
You hit a natural limit for efficient growth in that setup.
Okay. So the marginal product of capital falls. How does that lower stock returns?
Well, this is a really powerful and somewhat new insight from this paper. When that marginal product of capital is lower because you've invested so much,
Yeah.
that directly means lower expected future cash flows from those new investments.
Okay. Less bang for your buck going forward.
Precisely. And if the expected future cash flows are lower, then for any given discount rate, the expected return on that investment have to be lower too. Otherwise, the valuation doesn't make sense.
So higher investment drives down the productivity of the next dollar invested,
Right.
which lowers the expected cash flow from that dollar, which means a lower expected return on that marginal investment.
Exactly. Contributing to lower overall future stock returns for the whole firm. It's a direct economic link. Production function. Expected returns.
That makes perfect sense. Okay, so that's the cash flow channel, driven by decreasing returns. What's channel number two?
Channel 2 is the discount rate channel. And this works mainly through those capital adjustment costs we talked about.
Okay. The cost of changing scale quickly.
Right. Firms have a bigger incentive to invest when their marginal Q is high.
Marginal Q, that's the value of adding one more unit of capital.
Roughly, yeah. The net present value of future cash flows from one extra unit of capital. Now think about when marginal Q would be high. It happens when the market is discounting future cash flows at a low rate.
Meaning investors are patient, less risk-averse, things look good.
Exactly. When the discount rate is low, the present value of those expected future cash flows is higher. That gives you a high marginal Q, which strongly encourages firms to invest more. Take advantage while the cost of capital is low.
Okay. And the flip side?
If investors are very risk-averse or the economy looks shaky, they demand a higher discount rate. That makes the present value of future profits lower, low marginal Q, which naturally discourages firms from investing heavily.
So how does this create a negative investment return link?
Well, this channel, people like Cochrane, explored it back in the 90s. The idea is high investment today signals that the market's current discount rate is low.
Okay.
If the current discount rate is low, it implies that future discount rates are likely to be higher, mean reversion maybe, or simply that there's less room for future returns to be high because things are already priced assuming low discount rates. So high investment now predicts low returns going forward, partly because it signals a low current discount rate.
Ah, okay. So high investment happens when discount rates are low, and low discount rates today imply lower expected returns tomorrow.
That's the essence of the discount rate channel. So both the cash flow channel, the new insight here, and this discount rate channel work together. They both push in the same direction.
Establishing that robust negative relationship between investment and future returns. Okay, I think I get that. We have these two powerful economic forces making high investment today lead to lower expected returns tomorrow. But how does that connect back to our original puzzle, the equity issuance and buyback anomalies?
This is where it all clicks together. It ties back through something basic, the flow of funds constraint.
Flow of funds. Sounds like accounting.
It basically is. It's just an identity.
Yeah.
A firm's total sources of funds, internal cash flow, new equity, new debt,
Where the money comes from.
must always equal its total uses of funds, capital investment, dividends, buybacks, debt repayment.
Where the money goes. Sources equal uses. Got it.
And this is where the puzzle unravels. Consider equity issuing firms. Why are they issuing equity?
Because they need money they don't have internally.
Exactly. They
Yeah.
typically have very high investment needs. They've found really promising projects, things that they expect to generate value, but these projects require more cash than they're generating internally.
Okay.
So to seize these opportunities, they have to go outside. They issue new equity, even though it's
Sure.
costly, as we discussed.
Right, the flotation costs.
Therefore, just by their situation, these firms are disproportionately high investment firms.
Ah, okay, I see where this is going.
And given the model's fundamental negative investment return relationship,
These high investment firms will inherently have low expected returns in the future.
bingo. The equity issuance isn't the cause of the low returns in this model. It's a symptom of their high investment. And it's the high investment, driven by good opportunities but hitting decreasing returns or signaling low discount rates, that truly drives the subsequent underperformance.
Wow, okay, that reframes it completely. What about the other side? The cash distributors.
Same logic, just flipped.
Yeah.
Think about cash distributing firms. These are companies that, after they've funded all their optimal value-adding investment opportunities, they find they still have cash left over. Excess internal cash flow.
So their investment needs are relatively low compared to the cash they're generating.
Exactly. So what does a rational firm do with that surplus cash, especially if payouts are costless in the model?
Give it back to the shareholders. Dividends or buybacks.
Right. So these firms are, by definition, disproportionately low investment firms.
And following that negative investment return relationship.
These low investment firms will consequently have high expected returns in the future.
Okay, that is elegant.
It provides this truly unified, coherent explanation. Issuing equity, tied to high investment, leads to low expected returns. Distributing cash, tied to low investment, leads to high expected returns.
And this explains those long-term stock price drifts we see in the real world.
Exactly. And it does it entirely from a neoclassical perspective. Rational firms making optimal choices. No need to rely on investors being irrational or managers cleverly timing mispricings as the main cause.
It's a powerful demonstration of how these fundamental economic principles, they can actually account for patterns that look really complex, even paradoxical on the surface.
It really is.
Okay, the theory sounds incredibly solid, logically consistent, elegant, as you said. But, in finance, the real proof is in the pudding. Does it actually match the data?
The million-dollar question, always. How well does this carefully built model actually stack up against the real world? Do the predictions hold water when you could compare them to market observations?
Right. So how did they test it?
They took a really comprehensive quantitative approach. First step, calibration. They fine-tuned the model's 14 key parameters.
14 sounds like a lot.
It allows for nuance. They tweak them to meticulously match a set of well-known, real-world financial statistics, things like average investment rates, payout ratios, stock market volatility.
So they made the model's basic economy behave like the real U.S. economy.
That's the idea. Ensure it's grounded in reality. Then, the crucial step, simulation. They ran the model 1,000 separate times.
1,000 simulations.
Yeah, and each simulation tracked 5,000 hypothetical firms over 720 months. That's like 60 years of data per simulation.
Wow, that's a massive amount of simulated data.
It is. And it allowed them to rigorously test if the model's predictions line up with actual empirical findings, using the exact same statistical methods researchers apply to real market data.
So they treated the model's output like real data and ran the standard tests on it.
Precisely. The beauty is the internal consistency. You generate data from the model, then test that data. It lets you see if the economic mechanisms you built into the model are actually sufficient to explain the patterns we observe out there.
Okay. So what do they find? Did the model reproduce the anomalies?
The results are, frankly, pretty compelling.
Hmm.
Really showcases the model's explanatory power. First off, it strongly reproduces procyclical equity issuance.
Meaning companies issue stock more in good times.
Much more. The model showed equity issuance happening with a relative frequency of 82.5% during simulated economic expansions, compared to just 1.5% in contractions.
Wow, huge difference. And that matches reality.
Perfectly. It aligns with very robust empirical findings, going back to people like Cho, Mazzoulis, and Nandon in '93. Equity financing is largely a boom time thing.
And the model explains why.
Yeah, it's a natural outcome. In expansions, firms in the model get hit with positive productivity shocks. They see better investment opportunities, their optimal investment level goes up.
Right. Even though their internal cash flow also increases in good times, the scale of these great new investments often means they still need external money. Boom! Surge in equity issuance. Just rational firms responding to the economic cycle.
Okay, that makes sense.
Yeah.
What about the core prediction, that negative investment return link?
Critically, yes. The model unequivocally confirmed it. Simulated firms with low capital investment consistently earned higher average stock returns than firms with high capital investment.
Quantitatively, how close was it?
The model's average spread the return difference between low and high investment firms was about 10.1% per year. The actual data shows around 16.9%.
So a bit lower in the model, but
Ah.
still a big effect in the right direction?
Exactly. A profoundly significant qualitative match. It captures the direction and a substantial part of the magnitude. And even better,
Yeah.
it accurately reproduced a more nuanced detail. This negative relationship gets stronger when firms have higher cash flows. A finding from Titman, Wei, and Xi back in 2004.
Really?
Yeah.
The model got that interaction too. Yeah, the statistical slopes in the model for investment and the investment times cash flow interaction were remarkably close to the empirical estimates.
Yeah.
Really bolsters the model's validity.
The fact that it gets not just the main effect, but that conditional relationship, that says a lot.
It really does. It speaks to the strengths of the micro foundations.
Yeah.
It's not just painting with a broad brush. It's capturing these intricate details of corporate finance. Suggests the underlying mechanisms decreasing returns, adjustment costs are really doing the work.
Okay. What about the big one? The post-SEO underperformance, that classic Lofgren and Ritter finding.
The model successfully reproduced it. That puzzling pattern where companies issue stock and then underperform.
Yeah.
Lofgren and Ritter found about 0.49% underperformance per month. The model's prediction, a remarkably close 0.81% per month underperformance.
Wow, that is close. Captures a huge chunk of it.
It's not just qualitatively similar, it's quantitatively in the ballpark. And there's more. The model also showed this underperformance is worse after periods of heavy issuance activity, when lots of companies are issuing stock.
That matches the data too.
Yep. 0.90% monthly underperformance in the model after heavy issuance versus 0.60% in the data, and much weaker after light issuance activity, sometimes even slightly positive in the model, just like the data.
This is a really critical validation, isn't it? Because that post-SEO underperformance was always Exhibit A for the behavioral market timing story.
Exactly. Managers selling overvalued shares, investors underreacting. That was the narrative.
But this model shows it can arise just from rational investment and time-varying expected returns.
That's the key takeaway. It challenges the idea that irrationality must be the main driver. It offers a powerful, rational alternative for this long-standing puzzle.
What about the companies themselves, their actual business performance, not just the stock price?
Great question. The model also sheds light on the mean reverting operating performance of issuing firms. Consistent with other work by Lofgren and Ritter from '97, the model showed that firms issuing equity, they tend to have really good operating performance, like high profits, before they issue. But then their performance tends to deteriorate afterwards.
Why? Did they make bad investments with the new money?
Not necessarily. According to the model, it's more natural. It's due to the mean reverting nature of those firm-specific productivity shocks we built in,
Ah, the random good luck doesn't last forever.
basically. Firms that issue equity are often those that recently got hit with unusually positive productivity shocks. That's what spurred the great investment opportunities and the need for equity.
Okay.
But shocks, by definition, don't last. Over time, their productivity just naturally drifts back towards their long-run average. So performance looks like it declines post-issuance, but it's just reversion to the mean.
So it's not bad management, just the natural ebb and flow of firm-specific luck.
That's the model's explanation. It's an elegant, rational story for something that might otherwise look like managers got over-optimistic, then suffered a hangover. It pins it on economic conditions, not psychology.
Okay. Now, what about the flip side? The cash distributors, the ones whose stocks tend to outperform.
Here, the model qualitatively predicted the long-term outperformance following cash distributions. Simulated firms giving back cash did earn higher average returns than non-distributors.
And did it match the detail about value versus growth firms?
Yes, interestingly, it did. The outperformance effect was stronger for simulated value firms than growth firms, just like we see in the empirical data. Value firms, having fewer amazing growth options, are more likely to have that excess cash to distribute.
I sense a however coming.
However, and this is an important nuance, a limitation the authors acknowledge, the model could not fully capture the magnitude of this positive drift.
Ah, so it predicted outperformance, but not as much as we see in reality.
Exactly. For instance, real-world data shows average abnormal 4-year returns after buybacks of around 12%, and much higher, like 45%, for value firms. The model's numbers, while positive, were significantly lower.
Why the gap? What's the likely reason?
The authors suggest it's most likely due to that simplifying assumption we discussed, that distributing cash is costless in the model.
Right. But in reality, it's not free.
Definitely not. Cutting dividends can send bad signals. Buybacks have admin costs, legal reviews, there are tax implications. If you built those real-world frictions and costs into a more complex model of dynamic payout policy,
You'd likely get magnitudes closer to the data.
that's the strong suspicion. It highlights an area for future refinement.
Okay, that's a fair point. But even with that simplification, did the model get the operating performance right for distributors? Did their performance also mean revert?
Yes, it did. It successfully reproduced the mean reverting operating performance of cash distributing firms too.
So, similar to issuers. Good performance before, decline after.
Exactly. Firms announcing buybacks or dividends in the model showed superior operating performance before the announcement, but then it tended to decline afterwards, again suggesting they were riding a wave of positive productivity shocks, generated excess cash, and then naturally reverted towards their average performance level.
It's really remarkable, isn't it? The sheer breadth of facts this relatively simple neoclassical model can reproduce.
It is a single, coherent economic mechanism, optimal investment under constraints, explaining this whole array of patterns: issuance, payouts, performance mean reversion, cyclicality.
Things that historically often needed separate, sometimes even contradictory behavioral stories for each one.
Right. It really shifts the focus. From potential investor irrationality back to the rational decision-making of firms in a dynamic world.
Okay, this deep dive also offers something really profound, maybe even provocative, about the capital asset pricing model, CAPM.
Ah, yes, the elephant in the room of asset pricing.
Right. As we said, countless empirical tests show CAPM struggling, failing to explain these financing anomalies, other patterns like size and value effects.
Which has led many people to conclude CAPM is fundamentally flawed, maybe even dead, some say.
Exactly. But this is where the paper delivers a real aha moment, a potential paradigm shift.
What's the finding?
Li, Livdon, and Zhang's model, despite generating all these anomalies, shows that the conditional CATM actually holds exactly within their simulated economy.
Wait, key APM holds perfectly inside the model that creates the anomalies. How is that possible?
It's a huge finding. It suggests the perceived failure of CAPM in real-world data might not be a flaw in the underlying economic theory, but maybe it's due to fundamental problems and limitations in how we actually test it empirically. The test design itself might be flawed.
That is a powerful claim. Rethinking decades of CAPM is dead papers. So for listeners who've seen those critiques, what are the traps? Why do our tests fail, even if the theory might be okay?
The model highlights two main reasons. First, the age-old problem of noisy betas.
Measuring risk is hard.
Exactly. In practice, the betas we estimate from historical stock returns, they're supposed to measure systematic risk, right? but they're often just really noisy proxies for the true unobservable beta.
This isn't a new idea, right? Miller and schools were talking about measurement error way back.
Decades ago, 1972. And this model shows clearly when you use these estimated noisy betas in standard regressions to explain returns. Other stuff, like the firm's characteristics, investment level, size, whatever, often looks more important. It seems to dominate.
It's like trying to hear a clear signal through tons of static. The real signal, the risk-return link, gets obscured, and the background noise, the characteristics, looks more prominent.
Precisely. The measurement error just stops us from accurately seeing the true relationship. So it's not that risk isn't driving returns. Maybe we just can't measure it well enough with standard methods.
Okay, noisy betas is one culprit. What's the second?
The second is nonlinearity.
Meaning the relationship isn't a straight line.
Exactly. The true risk-return relationship in the model, and arguably in reality, according to many sophisticated theories, isn't simple linear, it's highly nonlinear.
Why? What causes the nonlinearity?
It mainly comes from a time-varying price of risk. How much extra return investors demand per unit of risk isn't constant. It changes, often with the business cycle. More compensation demanded in bad times, less in good times.
Okay. So when empirical researchers use standard linear regressions to test CAPM, even if they had perfect noise-free betas, they're using the wrong tool. They're trying to fit a straight line to what is fundamentally a curvy dynamic relationship.
And naturally, it looks like a bad fit.
Leads to spurious rejections of the model. You're just using a misspecified test.
The proof they offer in the paper is pretty striking too, almost a mic drop moment for the CAPM debate.
How do they show it?
They ran the regressions again inside their simulated world. But this time, instead of using noisy estimated betas, they used the true betas known perfectly from the model's mechanics. And boom! Those firm characteristics, like investment measures, no longer statistically significant. But the true betas, highly significant, explaining returns reliably.
Wow. So removing the measurement error made the characteristics irrelevant.
Largely, yes. And even more definitively, they then used the true expected returns, the actual expected returns generated by the model, which inherently account for all the nonlinearity and time variation.
Okay.
When they used those, none of the firm characteristics mattered anymore. The true expected returns explained everything.
Okay, that is compelling.
The takeaway is huge for empirical finance. The problems we see with CAPM in real data, maybe they're more about how we measure risk and how we test the dynamic relationships.
Then about a fundamental flaw in the core idea that risk drives expected return.
Exactly. It's a call to refine our empirical methods, develop better risk proxies, use econometric techniques that can handle nonlinearity and time variation, rather than just throwing out foundational economic principles because our current tests seem to fail them.
It's a call for better empirical science, really, grounded in better theory.
Right. Now, beyond just the numbers and the CAPM debate, this Q-theory perspective offers some broader, really interesting implications. It challenges existing thought, even if it doesn't, completely dismiss all alternatives.
Like a behavioral market timing idea.
Exactly. While the authors are kind of sympathetic to the idea that managers might try to time the market, they raise some really important questions about investor underreaction being the main or sole driver of these anomalies.
What's the issue they raise?
Well, it's about logical consistency. The behavioral story usually relies on investors consistently underreacting to the news in financing announcements.
Okay.
But if investors always underreact, then logically, all financing announcements should lead to long-term drifts in the same direction as the immediate short-term announcement effect. Right. Okay. If the market initially goes up a bit on news but underreacts, it should continue drifting up. If it goes down a bit, it should continue drifting down. Makes sense.
But that's not always what we see.
Oh, give an example.
Think about private placements of equity selling shares directly to big institutions, or bank loan announcements. These often cause a positive immediate stock price jump. Good news, right? Sophisticated players are involved.
Okay, positive reaction. So underreaction would mean
it should drift up further long term. But astonishingly, these same events sometimes lead to negative long-term stock price drifts.
Wait, positive initial reaction, negative long-term drift, that implies?
Short-term overreaction, maybe.
Yeah.
Definitely not consistent underreaction. Same thing's been seen with SEOs in some markets like Japan. Positive initial reaction, negative long-term drift.
These inconsistencies really poke holes in the idea that simple, consistent investor underreaction explains everything.
It suggests it can't be the universal explanation for all these long-term patterns. The neoclassical Q-theory model, though, neatly sidesteps this.
Oh.
It proposes a more nuanced view. It separates short-term from long-term effects. Short-term price moves around announcements. Maybe those are driven by asymmetric information.
Meaning some people know more than others.
Right, so a public equity offering in the U.S. might usually signal negative news. Firm needs cash badly, stock overvalued, causing an immediate negative reaction. But a private placement or a bank loan with sophisticated players doing due diligence, that might signal positive news, causing a positive reaction.
Okay, so asymmetric info drives the short term. What about the long term?
Crucially, the model argues these short-term moves are distinct from the long-term movements, those long-term drifts. They're primarily driven by time-varying expected returns, linked directly back to the firm's optimal investment decisions via that negative investment return relationship.
Ah, so different forces at play. Information effects for the announcement, pop or drop, but fundamental investment economics for the long, multi-year drift.
Exactly. It provides a more complete, consistent picture that doesn't rely on investors always underreacting in the same way.
That's a really important distinction, separating the immediate signal from the long-run fundamentals. What else?
The paper also provides a strong micro-foundation for explanations based on inadequate risk adjustment.
Meaning, the anomalies exist because our models just don't measure risk properly.
Essentially, yes. It really strengthens the argument that many observed anomalies might pop up not because investors are irrational, but because our empirical models, like the standard CAPM or Fama-French factors, are just misspecified. They don't adequately capture the true dynamic nature of risk tied to a firm's investment choices.
How does it strengthen that argument?
Well, it supports earlier findings, like from Brav, Getzey, and Gompers in 2000. They found that the post-SEO underperformance was heavily concentrated in small growth firms.
Okay.
The Q-theory model gives a compelling reason why. It shows that both equity issuers and small growth firms tend to be high investment firms. They're aggressively pursuing growth.
Ah, so their underperformance isn't necessarily a separate small growth anomaly or an issuer anomaly.
It might just be a reflection of a deeper common factor. They both invest a lot, and high investment leads to low expected returns, which standard models don't fully capture.
So the model provides the missing theoretical link for why an investment factor should matter so much for explaining returns.
Exactly. It gives theoretical backing for why things like capital expenditure growth might be crucial risk factors.
And one more thing, you mentioned pseudo-market timing.
Right. Finally, the model offers this elegant economic explanation for why firms often issue equity when stock prices are high. It looks like clever market timing, right?
Yes, sell high.
But the Q-theory model provides a completely rational, investment-based reason. It shows equity financing is highly procyclical.
We saw that in the simulations.
Firms simply have better investment opportunities, better productivity shocks during economic booms, and guess what? General stock prices are also naturally higher in booms.
So the high stock prices and the equity issuance are both driven by the good economic times and good investment opportunities.
Exactly. The increased optimal investment in good times frequently requires external equity. So it's not necessarily managers exploiting temporary mispricing.
Right.
It's just rational, value-maximizing investment behavior happening when times are good.
And this investment-based story works for both kinds of evidence, like looking over calendar time or focusing on the event itself.
Yes, it offers a unified, rational perspective that applies consistently across different ways of looking at the data.
Okay, so let's try and wrap this up. What have we really learned from this deep dive today?
Well, I think the big takeaway is that those really perplexing patterns, stocks doing poorly after equity issues, doing well after buybacks, patterns that fueled decades of debate about efficient markets.
Yeah.
They might not be primarily about irrational investors or managers sneakily timing the market, at least not as the main explanation. Instead, this robust neoclassical Q-theory model, like the one from Lee, Dan, and Zhang, makes a strong case that these external financing anomalies are fundamentally driven by something much more basic: firms making optimal investment decisions.
And that inherent, powerful negative link between how much a firm invests and its future expected returns.
Precisely. High investment leads to low expected returns. Low investment leads to high expected returns. And financing choices are largely symptoms of that underlying investment level.
It really provides a powerful, unified explanation, reproducing so many different empirical facts.
And maybe most significantly, offering that fresh, compelling reason for why CAPM looks like it fails in tests, arguing it's more about bad tests than bad theory.
It really underscores the enduring strength of digging into the fundamental economics of firm behavior, how rational choices can create complex market patterns.
Absolutely. It shows how powerful economic theory can be in illuminating things that might otherwise seem like pure psychology or market weirdness.
Now, while this specific model goes an incredibly long way, it also opens doors, right, for future research.
Oh, definitely. The authors themselves point this out. There are clear avenues for making the models even more complex, more realistic,
Like what?
like properly modeling the intricate trade-offs in payout policy. The real strategic decisions between dividends versus buybacks, factoring in signaling costs, taxes, flexibility.
And crucially, bringing debt into the picture more fully.
Yes, integrating debt financing properly is a huge next step.
Why is that so important?
Well, remember, the model's main limitation, not quite matching the magnitude of the buyback outperformance.
Yeah, likely because payouts were assumed costless.
Right. Modeling those costs realistically would help, but also adding debt allows you to explore the whole interplay between capital structure, financial distress risk, investment, and expected stock returns.
Which could potentially shed light on other big puzzles in finance.
Exactly. Things like the credit spread puzzle, why corporate bond yields seem higher than expected, or the leverage effect on stock returns. A richer model incorporating both costly equity and costly debt could offer insights there too.
Imagine the detail we could uncover. If we really modeled the true costs of giving back capital, or the complex links between debt, financial health, and investment choices. This paper, while answering so much, really feels like a launching pad.
It absolutely is. It provides this solid theoretical foundation, something for future empirical work and more theory to build on, pushing our understanding even further.
So final thought for you, our listener. The next time you hear about a company issuing new stock or announcing a big share buyback, maybe pause for a second.
Hmm.
Beyond the instant headlines, the short-term market buzz, consider this.
Yeah.
What might that decision really tell you about the company's fundamental investment opportunities, about its capital structure strategy?
Yeah.
How might those basic economic choices be quietly shaping its long-term stock performance in ways that go deeper than just simple market timing or what the crowd thinks today?
What does it imply for how you perceive company value, market efficiency, your own investment approach?
Keep exploring. The deep dive continues.